All right, what's up, guys? Hope you're doing well. James here from jamesdforsythe.com. So I wanted to go over kind of what exactly is market liquidity and how that kind of applies to the Treasury market, right? Because especially right now, because going through the recent November 2022 Federal Reserve's Financial Stability Report, we're starting to see that there are some problems with Treasury market liquidity, which would also kind of explain what the Treasury is kind of proposing around this time anyway. Basically, by trying to buy off the run Treasuries and basically issue more on the run Treasuries to kind of help improve that liquidity and kind of plan on describing why exactly that's an idea, right? How exactly that would work and why it would improve liquidity in that respect, at least with this theory, right? So market liquidity is the ease of buying and selling an asset, right? And it is a key indicator of how well markets are functioning, right? You have to be able to buy and sell in a market. That's the whole point, right? So low liquidity can amplify the volatility of asset prices and result in larger price moves in response to shocks, right? Mostly because, if you have no one who's actually going to bid for whatever ask price, you got to basically, whoever's asking or selling has to come down, most likely in that respect, right? You kind of see this a lot with housing, or at least that's the example that comes to my mind. If you're trying to sell your house, you're asking a certain amount. You always think it's better than everyone else's, right? It's your house, right? Whatever the case may be. And if no one's going to bid for it, no one's going to put any offers in, then it's like, eventually at a certain point, if you actually have to sell the house, you're going to have to come down, right? Especially if the real estate market isn't doing well. Kind of the same idea, right? And so we're kind of reflecting this into the Treasury market, right? So the Treasury market has continued to function smoothly since basically May, right? The last time the Fed put out the financial stability report was in this past May, right? So, excuse me. But measures of trading costs have remained moderately elevated and liquidity appears to be less resilient than is typical, right? And so these liquidity strains appear to be primarily a consequence of the elevated interest rate volatility associated with uncertainty about the economic outlook, what the Fed's doing right now with raising rates and all that sort of thing, right? Is it going to be 75 or 50 basis points or that kind of argument, right? And so while measures of trading costs such as bid-ask spreads are only moderately elevated, the fact that intermediaries are posting historically low volumes of quotes may mean that the risk of a sharp further increase in trading costs could be higher than usual, right? So basically, so let me rephrase this. So the less liquid a market is, the more likely the spread between the bid and ask prices can grow, right? Because if it's liquid, then basically it's very easy to buy and sell. Most likely the bid and ask spreads are very small because, selling and buying are easy. That whole trading aspect, it's flowing, right? And so basically buyers and sellers are agreeing. Well, when they're disagreeing, you have that illiquid market to where they're not flowing like they should, right? So looking directly at this with respect to the Treasury market, right? And kind of touching on a previous video I did a couple days ago as well. So the most liquid component of the Treasury market is the interdealer broker market in on-the-run Treasury securities where trading takes place predominantly on platforms employing a central limit order book, right? CLOB, right? And I did a video on CLOBs and I'll put it up in the corner just so you guys can see that if you don't know what it is. Because when I was first looking into it, I wasn't 100% sure exactly how they would work, kind of how the order flow would work and that sort of thing. So I wanted to look into it. And I kind of made a short video going over it pretty much and put resources there, right? And so basically, another thing to clarify is the on-the-run and off-the-run Treasury part. So on-the-run Treasuries are the most recently auctioned securities of a given maturity, right? And so while the off-the-run securities are those that were auctioned earlier. So basically fresh off the press, even though I know it's not like printing them, but just to give that kind of analogy, right? And so kind of looking more into, I guess it's a good time since I bring up the off-the-run, on-the-run argument, is to kind of explain a little bit more of the what the Treasury's doing or planning on doing. I don't know if they've started doing it yet or if it was just kind of thrown out there for whatever reason. But remember what I said a few minutes ago, or I guess only a few seconds ago, but basically this part of the treasury market that we're talking about is the most liquid component, right, of on-the-run treasuries, right? So basically the Treasury Department, to kind of distinguish between the securities and the department, the Treasury Department would buy off-the-run treasuries because they're not as liquid. They are not basically, I guess, they don't have the whole duration left. Just to kind of talk about that a little bit more. So like if it's a 10-year treasury, you know, it's got 9.5 years left or whatever. I don't know. Less than what they would be, right? If it was brand new, if it was just auctioned off. To whereas this is part of the reason why you see with the very beginning end of the yield curve with like 4-week treasuries or 4-week bills and that sort of thing, you know, those are basically always on the run because they're pretty much always issuing them out every month, right? I think twice a month, if the last time I looked at the auction schedule, but I may be wrong about that, right? There's so many lines in the sheet, so but besides that, right? So, and that's part of the reason why when you look at 4-week bills, they're like the much shorter end of the yield curve, right? Of those shorter maturities, those are mostly used for their liquidity characteristics, right? You hear a lot of investors now, and I've talked about this because that's one of the things that I'm doing myself, right? Is using the 4-week bills and that sort of thing as kind of a place to put liquid assets to not just hold in the bank, because one, they're yielding higher than your bank account or your savings account, whatever, and two, it's just they're liquid, right? You can sell them or you don't, doesn't really matter because they're going to basically mature in a month anyway, not even. But kind of to touch a little bit more on that, right? So basically taking less liquid off the run treasuries and issuing more liquid on the run treasuries in order to kind of fix this liquidity issue in the treasury market, right? Because especially these short duration treasuries are really what's kind of flowing throughout the system that you hear about all the time. So like with 2008 and that sort of thing, when you started to hear about like liquidity freezes or however they phrased it, right? Basically you hear illiquidity or liquidity freeze, especially within a monetary context. That's pretty much what they're talking about, and that's why these T-bills are used for that. Whereas for 2008, the whole argument is basically they were using mortgage-backed securities instead, right? Or as well, I guess I should say. And again, not going full in depth, there's a lot more into it, but that's not the purpose of the video, right? And so to also kind of look in contrast, because to understand, you know, there are different components of the treasury market to kind of move along in the whole train of thought for this. So this is just with respect to this interdealer broker market, right? For the on-the-run treasuries that we're talking about, the ones using CLOB, right? So in contrast, there's also a dealer to client trading in off-the-run treasuries, securities, which largely takes place using the request for quote or RFQ protocol, right? Whereby clients of treasury security dealers can obtain quotes for buying or selling a certain amount, basically calling up the dealer and being like, give me quotes and so on. And I believe they actually get like a list, if I remember correctly, and it's like I think you can either sell to the highest bidder or you can buy from the bottom of the bids, right? The least, whoever's offering the least amount or whatever, you can buy from them, but you can't like split the difference, if I remember correctly. So to keep that in mind, right? There's different components is the main reason I want to bring this up. Is there's different components of the treasury market, and when we're talking about the liquidity problems, we're looking at specifically one aspect of it, right? And so to continue, market depth at the top of the book is the average of quantities available to buy or sell at the best quoted prices. So greater market depth indicates a greater ability to instantaneously trade larger amounts without moving the price, and hence a more liquid market, right? And so basically in practice, market depth is basically an imperfect measure of the ability to trade without moving the price, because quotes can both be rapidly canceled or rapidly replenished in response to incoming order flow, right? To basically just quote their definition of it, right? So again, basically there's enough orders in the book for your order to be filled. You don't have to break it up into multiple orders to get your full, to get all that you need, right? And so like I forgot where exactly I saw it, but something to where basically participants in like that are doing these, I think it was specifically RFQ protocols, basically, calling up the dealer and going on, they had to break up they're having to break up their orders because they can't get, I don't know, 1,000,000 treasuries, just to throw a number out there to give a kind of a rough example in the concept. So like they can't buy 1,000,000 treasuries, $1 million in treasuries. Right now they have to break it up into, I don't know, half. So you have like 500,000 in one order and 500,000 in another just to get filled, right? That's kind of what we're talking about. So as kind of a final concept, the bid-ask spread, right, is the difference between the best bid quote to buy an asset and the best ask quote to sell that asset. Kind of what we were talking about before. So smaller bid-ask spreads indicate lower trading costs and hence more liquid markets, which I was kind of touching on before as I was explaining it without the help of the financial stability report, right? And so kind of as a footnote that they have is in liquid CLOB-based markets, the bid-ask spread is often close to or at minimum tick size, right? So one tick, whatever that size happens to be for that market, right? And so the smallest allowed difference between bid-ask spreads, and widens only for short periods during the day in response to incoming orders. However, average bid-ask spreads over the course of the day may still be informative about the variation in liquidity conditions over time. So you can also look at those as a kind of proxy for liquidity, right? Because it shows kind of how much inflow and outflow is coming in, or it can show you the difference between the inflow and outflow of orders so that you can kind of understand, how exactly is this, how liquid is this going, as opposed to just market depth, right? Because we might not always have access to, say, the market depth metrics, right? As we see with the difference between the CLOB-based markets and the RFQ-based markets, right? And I think I talked a little bit about this more in depth in the CLOB video, about basically how it works and why that's kind of the case. So I'll leave that as a reference, right? So yeah, I'm basically just going to leave this one here for the end. I don't want to have an overly long video. I like to keep it kind of short and sweet and break it up into concepts. So as always, the links to the report and anything else that I find helpful, relevant for this video, I'll put in the description as always. I always put sources in there because that's just, I think you have to. So especially if you're using it to learn something, or even if it's just helpful, because sometimes I throw links to maybe it's different publications or even ones that I didn't actually use. I just think they're helpful in general, and I'll just put them in there just because I would want access to that as well. So anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.